Today, everyone, we're going to be talking about how the legal protections that you often assume are in place to keep you safe in deals or purchasing things uh, simply just don't apply in the world of buying a business. So stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, so I was watching something online, and there was a local politician talking about a law that they were working on and how it related to consumers and consumer protection, and it got me to think about how these things simply don't apply in the world of business deals. And sometimes I actually run into people that are dipping their toe into this world, and they're becoming interested in the idea of buying a business, and I sometimes actually have to say this to people, that, hey, you have to be careful because the things that protect people as consumers simply aren't there when we're making business deals. So I made a quick list here of the kind of laws that we often think about when we're talking about, being an individual. Like if you go and you buy a washing machine to wash your clothes, for example, you assume that it meets certain kind of minimum safety standards, and you buy it knowing that if it fails and breaks down and just doesn't deliver as it was supposed to, that you've got the right to return it or to seek some kind of compensation from the person that sold it to you. And if they don't make you happy, you have recourse to different kinds of arbitration or legal mechanisms that have been created through consumer protection laws. So I'll go through a list here. So I've got product safety laws. Consumer goods have to meet certain safety standards. There has to be a recall system in place, compliance certifications. When you buy a business, for example, you could have bits of machinery in that business. If you don't know to create any kind of warranty or guarantee mechanisms in the deal that you make, then if a piece of kitchen equipment or something in the business you just bought fails, well, there's no warranty. Like it's not like you bought the piece of equipment from a local department store. Fair trade and advertising laws. If advertisers lie to consumers about what they're offering or what their product will do, there's a way for you to complain about that. And, everyone's kind of held to certain standards about truth in advertising. But if a business that's up for sale has a broker representing it who claims that the business earns $20,000 a month in cash flow for the owner, and you buy the business and it never performs that way for you, you can't go back and complain to some kind of government agency that the business isn't doing what they claimed, unless you can actually prove that they've defrauded you, right? Which is difficult. Like you actually have to prove that they were not earning the amount of money they claimed, because of course they're just going to say that you don't run it properly and that you scared away some of the good customers, right? And so again, a lot of this stuff just doesn't apply in the world of small business. Consumer contract protection. If you've ever had remorse after buying something expensive, sometimes there is a cooling off period law of some kind, depending on where you live, that gives you the right to just say, oops, I changed my mind and go back on something. Right. And so this exists for certain kinds of investments, certain kinds of major purchases. It exists in the world of franchises when you're buying a new franchise. But generally in the world of buying a business, once you sign, your contract deal and you've bought the thing, you can't just go back and say, oops, you now own it. Uh, Refunds, returns, and warranties. You can return a pair of shoes. You can't return a laundromat. Once you own it, you're married to every machine, consumer problem, customer problem, cash flow surprise that comes with it. Like, again, you can't take it back. E-commerce and digital purchase protection. So, in the world of online shopping, even if you're looking at a marketplace like eBay or Amazon, if you're not being treated well by the person selling something to you, you can leave some kind of feedback. You can report the seller to the platform. You can leave a low rating, etc. Uh, these kinds of mechanisms just don't exist in the world of buying a business. I suppose you could give negative feedback in some way on the broker if there's a broker involved. But the seller, usually, once they've sold that business, they don't have any more to sell. So their reputation as a business seller, even though you might damage it by letting everyone know, isn't going to have any real impact on them going forward. Um, Price gouging and anti-scalping laws. This is an interesting one. So, some markets regulate excessive pricing during emergencies, for example. In business sales, there's no limit to what someone might charge you. It's up to you to negotiate a fair and reasonable price. Personally, the worst scenario I've ever run into was someone who overpaid by about 10 times for a business. And they bought the business, they overpaid dramatically. They ran the business for several years. And it was only later when they were trying to sell it again that they realized that they had overpaid because then they, of course, they had to initiate the process of figuring out what the business might be worth to someone who they might sell it to. And they were really disappointed by what different brokers were telling them. They eventually found me and I showed them that what the business broker they talked to had told them was pretty accurate, and they're like, "But how can it be worth 80% less than than what I paid?" And I said, "Well, it's because you paid 10 times more than what it was worth." I regularly meet people who overpay by 50, 60, 100% for a business. And I even run into people who get what they believe is good, sound advice, and then realize later when they understand that certain parts of the expense of running a business were never taken into account in their cash flow calculation, that even though they thought they were getting a good deal, they still ended up overpaying for the business. And the way that is often reflected is when you buy the business and then you realize there's just not enough money to cover everything, and you start to cut your own wages in order to cover all the bills and pay everything that you need to pay. And you think, geez, um, this isn't such a good deal. I think I paid too much. Again, that can happen years after you actually do the deal. Um, with respect to investments and financial projections. So, we talked about consumer protection laws. Let's talk about the laws that are in place that protect people in the world of investment planning, right? Because if you're going to buy an investment like a mutual fund or buy a stock from a stockbroker or whatever, there's sets of rules around that stuff too, most of which don't apply at all when you're buying a business. So, securities and investment regulations, you might think that I often describe buying a business as like buying a cash flow, which is similar to maybe buying a bond or something like that. But legally, it's not considered the same at all. If you buy stock in a public company and it turns out that there's some kind of problem or there was, you know, uh, fraud or misstatements in the financial statements of that company, then regulators are going to step in on behalf of all of the investors in that case. Um, don't expect any regulators to step in your small business deal. There aren't any regulators in the world of small business deals. There are police in that will examine cases of fraud, but again, proving that is really difficult. Fiduciary advice protections. A financial planner has to act in your best interest. A business seller does not. In fact, we know that a business seller is acting in their best interest. And sometimes there is an intermediary, a business broker. But in many jurisdictions, business brokers will actually get buyers to sign something saying that they understand that the broker is not a fiduciary for them. In other jurisdictions, um, there actually may be a requirement for the business broker to get both of the buyer and seller to sign some kind of document saying that they are a fiduciary and they have a fiduciary responsibility. When I was a business broker, that was the case here because business brokers were covered under real estate legislation. So I actually had to get both parties to sign something saying that I was acting as a fiduciary in both of their interests, and the way that I would manage that is I would simply say to both of them that if they ever said anything to me or I learned anything about the deal or the buyer or the seller, that I would probably share that with the other party. And so, like, I didn't know how else I was going to do that, because if I have this duty of responsibility to both parties, in my mind, the way to manage that duty is to be transparent and honest and forthright and give as much information as possible. And the way that I manage that with sellers is I would say, look, my duty is to both of you. I'm going to help try to get a fair deal facilitated as quickly as possible. And the people that were looking for somebody to help them rip somebody off generally just didn't jive with my vibe, and they wouldn't hire me, right? So it was kind of a way of gatekeeping to make sure that I ended up with sellers that were pretty good people. Um, so sorry, that's fiduciary advice protections, fraud protections, and scams. So scams like a Ponzi scheme are illegal, but you know proving that the seller lied to you and that they committed a fraud or a scam is incredibly hard. Um, you know, a comment that I read when doing research for this is from one lawyer, said that the line between fraud and salesmanship can often be very thin, and I think that's a good way of expressing it. Um, so other where areas where you may not be protected. So this is an interesting one that I found: data privacy and confidentiality. Often, business buyers are required to sign NDAs that protect the business owner and the broker from buyers releasing their information publicly, but rarely are buyers' information is ever protected. So sometimes a broker might ask you for personal information about yourself, your net worth, etc., source of funds, all that kind of stuff, but you have no protection on your data. And so I've actually run into a couple of buyers who have, especially when they find these onerously worded NDAs that have a lot of stipulation and guarantees and stuff. I've met a couple of buyers who have their own, and they're like, "I'll sign yours if you sign mine," as kind of a negotiating thing. Credit and lending protections. So loan laws in general protect consumers, but they usually just don't apply in any way to businesses or business loans. That business loans are a commercial product, and there are fewer disclosures required typically in most jurisdictions. There are fewer protections, and there is more risk. This is why we have high cost predatory lenders such as merchant cash advance operators in the business space, because they don't have to conform to things like usury laws, which typically only apply to consumers in most jurisdictions. Um, Debt collection and personal guarantees. So if you get into trouble with your business loan and you personally guaranteed it, obviously your assets are going to be exposed. Um, No complaint, no resolution, ombudsman or regulators. Again, I mentioned this earlier. So, like, I've never heard of any jurisdiction having a regulator or ombudsperson that dealt with small business transactions. These are one-to-one private business dealings, basically governed by contract law, because ultimately, if there's a problem between the two parties, any judge or whatever is going to say, "What does the contract say?" Right? They're gonna look to that document, which is why it's so important. Class actions of some kind, like, probably not. There I think that there probably have been class action lawsuits maybe against franchisors or something like that. But, organizing a bunch of business buyers together to make a class action lawsuit against who? Against the sellers? Maybe a broker? When I was a business broker, I had a document that had to be signed at the conclusion of a deal, which basically was an indemnification and hold harmless agreement that buyers would basically state that I, was basically just relaying information given to me by the seller, and that I wasn't responsible for any of that information, that they had to do their own due diligence, et cetera, et cetera. And I would imagine that any decently qualified business broker is going to have the same kind of thing, because ultimately that's all the business broker's doing is they're taking information they've been given by the seller, and they're repackaging it, formatting, et cetera, to present to the buyers. Business brokers don't audit their selling clients or anything like that. So I don't know how any kind of class action lawsuit would be applicable in this domain. Um, so, you know, the law basically treats people doing business deals as though they are big boys. They're grown-ups. They're mature and they're sophisticated and they know what they're doing. They don't have training wheels and they don't need hand-holding. So what this means is that the responsibility is entirely on you as a business person when you're getting involved in a deal like this to make sure that you understand what could happen, what scenarios might exist, and that you work to make sure that you protect yourself from those scenarios uh, through two different important mechanisms. Number one would be the structuring of the deal, and number two would be like the paperwork that the attorney helps to put together to make sure that the different provisions that you work into the structure are actually represented in the paperwork, so that if something goes wrong, you've got these ways of adjusting the deal after you become the owner. Um, you have to assume the burden of due diligence, risk assessment, and the deal structuring, as I said. So here's some real world examples I want to share with you. These are from some of the people that I've worked with as buyers, and from someone who I did not work with as a buyer, but had a long, hard conversation with after they bought a business. So there was a case where I sold a pizzeria, and it turned out that the seller was claiming that there were these unreported cash sales, and the buyer paid a price that took into account those unreported cash sales for the business. And it turned out after the deal was done that those unreported cash sales were not nearly as large as what the seller had claimed. Okay. So that was an example of what we're talking about here. And I'll tell you in a minute how we dealt with that. There was a second example of a salon owner. This was the lady who I didn't work with. She bought a business and then afterwards discovered that the previous owner had gone into their point of sale system, inputted a bunch of transactions, which weren't real, to inflate her income amounts to a point that wasn't real. So she unrealistically inflated her income. And then she reported it on her tax return and paid income taxes on the inflated amounts of money and sold the business. And the buyer bought the business based on those inflated numbers. Okay. So where did that particular deal fall apart? Where did she fall down? She didn't do proper due diligence because she looked at the financial reporting and the tax returns but did not relate those numbers to an independent third party source of data, which would have been the bank. Because the bank statements, of course, don't show didn't show deposits adding up to the amounts that of sales that they were declared. A third example is a client that I work with, a buyer, bought a business, and then after they bought the business and they were getting ready to file their first tax return, the accountant of the seller, who the buyer retained, uh, actually admitted that they manipulated the work in progress on the balance sheet and that there were intercompany transactions between related companies that the seller owned that were used to inflate the earnings and profitability of the business that my client bought. Okay. So, so just garbage financials again. And they've learned about this after the deal was done. So, how do you protect yourself from this? And I'm gonna talk about those 3 examples I just gave you. So, number 1, you gotta have a professional team of people that you're working with to get these deals done. So you need, appraisers, accountants, lawyers, people who are qualified, who are experienced in doing these deals, and who are going to help give you good guidance. You're going to need to do proper due diligence, which is why this team is so important. You want to get some third party advice on the valuation. This is what we help buyers with. We do our buyer insight analyses. We also do the training, the Business Buyer Advantage online training, etc. Um, Understand that saving money on things like due diligence might end up costing you 10 times later. And if you don't think it's worthwhile to do due diligence and spend the money on that, then you can also protect yourself through the deal structure if you can get the seller to agree to the deal structure that protects you. So, and this is what a big part of my Business Buyer Advantage .com training, the online training, is about how to look at these deals and structure them properly to protect yourself. So, how did things work out for my clients? So, the pizza owner. So remember, I was representing this pizza seller. He lied to me. That information got into the business profile, et cetera, and was presented to the buyer. When the buyer was making an offer on that business, I said to them, I'm like, part of the revenue that's being declared here is not proven. It's undeclared cash revenue. What are you going to feel, or what's it going to be like for you if it turns out this is not true? Like if it turns out these sales are false. And what the buyer said to me is he said, "Look, for the price I'm paying for this business, I would not be able to build this pizzeria." So the price was, this amount. The down payment was just over half of the total purchase price. And that's what he was talking about. He said, "I could not build this pizzeria for the amount of the down payment." And what we did is we built into the deal a sales warranty so that if it turned out that the sales of his business were below certain benchmarks, that part of the seller note would be written off. After 6 months of ownership, it became evident that the whole undeclared cash sales things was just totally inflated and blown out of proportion. He ended up writing off 80% of the seller note. Okay. So, and this is how deal structure protects buyers. So at the end of the day, he paid much less for the pizzeria than the actual contract was for. And he felt that he got a fair deal because he was contemplating that. He was saying, what if this turns out not to be true? Would I be, excuse me, would I be satisfied in my deal if it turned out this was a lie and this is the lower price that I paid? And for him, the answer was yes, right? And the important thing about that deal structure is that he didn't have to then go and sue anyone. He didn't have to go and, try to undo a bank loan, or he didn't have to try to get money back from the seller. He controlled the flow of the funds. So it was he decided, no, look, the results are not matching what you told me. I'm not going to pay you. And if the seller had a problem with that, the seller was going to have to sue him and prove in court that he had these higher sales, which he had said were undeclared cash sales. So how was he going to prove them? Right. And this is why deal structure is so important, especially with these small businesses. Now, the one about the seller's accountant who manipulated a work in progress and had the intercompany transactions, right? Again, this was a case where this buyer was working with me. He learned these tricks from me. The vast majority of the purchase price in this deal was seller financed. And so when these things became uncovered, guess what? Same thing. It was, hey, you did this, you did this. How about you sign this new agreement saying we will not disparage each other publicly, and I'm going to write off 90% of the seller note. And so again, the buyer secured themselves a discounted purchase price after the fact because they were aware of the kinds of things that could happen in a deal, and they negotiated a structure that protected them from those what ifs. And this is a big reason why, one of the things that I've often said is that if you have a seller who flat out refuses any kind of seller financing or any kind of performance-based payments over time, and it is not absolutely crystal clear what is happening in the business. So, um, you know, it's your due diligence is not 100% certain of what's happening in the business. That's a red flag. Because that says to me that the seller knows there's a problem. Like, if the seller doesn't have the confidence to back up their words with actual cash, then it means that there could be an issue there. Sellers who run really tight businesses where everything is by the book and everything is recorded properly and everything is totally transparent, they don't need to do this as much because they can stand behind their work, right? That, like, all the documentation is there, all the tax returns match the financial statements, which match the bank deposits, et cetera, et cetera. And so learning these structures and learning these deal making techniques is really important for the smaller businesses where you don't have the same level of professionalism in the paperwork and the accounting and the recording of stuff. So, closing point, buying a business is going to be one of the biggest bets you're ever going to make. It's a bet on yourself, and it's a bet on your team in helping you do the due diligence to make sure that you absolutely understand what it is that you're getting, and it's a bet on your ability to foresee what could be the problems, even if they're not problems created by the seller. So, what do I mean by that? Well, there's other scenarios too. Like, I've worked with buyers who have negotiated some degree of seller financing. to help them get the deal done. And they've thought, what if there's a recession coming, or what if there could be a downturn, or what if there could be a new competitor? And they've worked certain conditions into the seller note, not necessarily to write down the note if one of these other things is to happen, but to pre-negotiate changes that they could affect to help them with their cash flow in the future if one of these things should happen. And I talk about that, of course, in Business Buyer Advantage. In particular, there's a module there on deal making if you believe a recession is coming, or buying a business in a recession, where I talk extensively about how you can have these sort of modified terms, again, not to pay less for the business, but to be able to react to downturns in your own cash flow by having pre-negotiated terms in those seller notes that help you with cash flow. Just means the seller sometimes has to wait a little bit longer for their money, but they'll get to collect it because you'll survive. Um, so you want to go into these deals with your eyes open. Go in with a team that's going to empower you, and make sure that you know what you're doing. Head over to businessbuyeradvantage.com. You can learn more about all of this stuff. Um, that's not the right one. Businessbuyeradvantage.com. You can learn about the online training, the group coaching program that I have, and at the very bottom of the page, learn about the buyer insight analyses, which is where me and my team actually help evaluate businesses that you've found for sale, and can give you an opinion on what we think a fair, reasonable first few offers might be, and where we see particular risks or hazards or red flags in those deals. And with that, I'll say thank you very much. Great to see you all again, and be safe, because the government's not watching out for you in this space. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally, and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.